Welcome to the third tax planning variable video on conversion. So this name is certainly the most meaningless to me, but we will forge ahead. So hopefully you've garnered some appreciation for the fact that tax rates can vary across different activities. So for example, ordinary income is taxed at ordinary rates. So up to now, all the individual tax computations we've been doing for the most part have involved nothing but ordinary income. And we take our ordinary income and we go out to those tables that are based on your filing status and put them through the grinder, and we get a tax liability. Long-term capital gains for individuals are taxed at preferential rates. And we should have also learned that some income is just flat out tax exempt, right? By now we've learned that municipal bonds are tax exempt forms of income. And so conversion is about characterization, because characterization of the income makes a difference when it comes to after-tax return, because you may pay a different pre-tax return or you may have a different tax rate that applies to it. So conversion is the concept of taking either an income or a deduction and recharacterizing it as a form of income or deduction with either a lower for income or higher for deduction tax rate. So let's say you're an investment advisor and your clients pay you money to make good investment choices for them. And so they either pay you commissions as a broker, or my preference is the fee-only advisor. So you're a fee-only advisor and they pay you a fee for your planning exercise. And that fee is ordinary income to you. But the reality is you're a really good investment choice picker. Like, you're excellent at that. And so you decide that you want to share in the investment. So when you bring a new client on, not only do they invest, but you also invest in your own choices. So to the extent the return on that is capital, that's going to be a capital gain to you. And as we just learned, you are going to enjoy preferential rates on that if it's long term. So you realize, well, what if I just reconfigure my advising contract? So rather than have them just pay me a fee, maybe I keep a portion of it as a fee. So I say, well, look, I'm going to charge you a 2% fee for assets under management. But then I'm also going to charge you 20% of your return above maybe some certain threshold. So you say, well, look, if I beat the Standard & Poor or the Dow Jones Index for the year, then I'm going to keep 20% of that excess return over the Dow Jones or the Standard & Poor's 500 return. By doing so, you've just converted your income from ordinary fee income to capital gain income. That's what conversion is all about. So before we move on, let me talk a little bit about implicit taxes and some of these other things that we've already covered. So Sandy's contemplating 3 different investments, each with the same amount of risk. So there's a high dividend stock that pays 8% yield on dividends annually. And I'm making the presumption that there's no appreciation potential in the stock. So think of it like it distributes all its earnings out through dividends. She could invest in taxable corporate bonds that pay 8%. Or she could invest in tax-exempt municipal bonds that pay 8%. And assuming that dividends are taxed at 15% and that Sandy's marginal tax rate on ordinary income is 35%, which investment should Sandy choose? Because these all have the exact same pre-tax return. And we're going to wave our hands at differences in risk and volatility and these other things. And we're going to assume that the risk profile for all 3 of these is the same, though that is completely unrealistic. So if they all have the same pre-tax return of $800, then really what it boils down to is an examination of the after-tax return. And by now, for goodness sake, we've definitely learned that we can calculate the after-tax return because that's what really matters. So we apply the tax rate, we get the tax, we deduct that from the pre-tax return, we get the after-tax rate of return. And you can see that on an after-tax basis, it's pretty clear that in this case, the tax-exempt bond would be the preferential choice here. It returns 8% after tax, whereas the other 2 return less. And so we know that there's a shortcut calculation. We've already done this. After tax equals pre-tax minus taxes. And we know that with a little algebra, we can convert that to after tax equals pre-tax times 1 minus the tax rate, which meant we really could have done a much quicker analysis on that previous scenario where we could have calculated the after-tax rates very quickly. But in any event, here they are. So Sandy works for the city of Bikini Bottom in the finance department, and her primary responsibility is for the issuance of those city bonds. And Sandy noticed that the corporate taxable bonds that share all the same characteristics of Bikini Bottom bonds, except for taxation, they're paying 8%. And Bikini Bottom has two investors, SpongeBob, he's got a marginal tax rate of 35%, and Patrick, who has a marginal tax rate of 12%. So she considers the following hypothetical example. So if SpongeBob were to invest in the taxable bond versus the Bikini Bottom bond, he would have a huge difference in his after-tax returns as a result of choosing Bikini Bottom. Clearly more advantageous because, of course, there's no tax. Patrick looks at the same situation and, well, there's some advantage, right? The taxable bond at a 12% rate only pays 7%, but still, he'd prefer the 8% rate on the Bikini Bottom bonds. All the same. Well, Sandy's degree is from SDSU, and she knows all about implicit taxes. And she says, well, wait a second, we can save some money if we lower the rate. And so what happens is Sandy lowers the rate on the taxable bonds to 5.2%. In this case, SpongeBob would be completely indifferent, and we would describe that as the tax equivalent yield. But at 5.2, Patrick, well, he's a little less interested. So at 5.2%, Patrick wouldn't be interested because he's going to take the taxable bond. But at 7.4, that's Patrick's tax equivalent yield. And that brings up this notion of, well, as long as there are enough SpongeBobs, then Sandy could offer these bonds at 5.2. But if there aren't enough SpongeBobs and there are some Patricks that she's going to have to attract, then she's going to have to offer more than 5.2 in order to attract a Patrick. And that includes like anyone that might be between, of course, Patrick and SpongeBob. And we call those tax clienteles. So SpongeBob is in one tax clientele. Patrick is clearly in a different tax clientele. So we know about this implicit tax, and we know that this accurately describes the municipal bond market. The reason I bring this up again is that implicit taxes are a limitation on our ability to use the conversion planning strategy, right? Because what's going to happen is Sandy's going to set those Bikini Bottom bonds down to 5.2%, and it's less likely that SpongeBob will be able to take advantage of that conversion from taxable bonds to tax-exempt bonds. So another thing that does that is the code prevents us from just willy-nilly making choices, right? So we had to change the way we contracted if we were an investment advisor. And by the way, that entire process is exactly what hedge fund managers have done, which is why they had taken such a beating in the most recent rounds of tax reform. And even though they've done something to try to get rid of that, they haven't completely eliminated it. And then there are other doctrines that prevent the conversion, such as business purpose, step transaction, and substance over form, but we're going to talk about those in the next video. Okay, nice short video. This is the end of video 3E. Thanks for watching.